Okay, I believe we're live here. We're going to start talking about partnerships, and the key is what is a partnership. Let's see if we can get a large font in here so we can do some illustrations. And the key is, can I move that over here? Okay, so here we go. All right, perfect. So partnerships is what we're going to be talking about. That's a good spelling. And basically, a partnership is, by definition, a business entity, but it is not a legal business entity. It is really what we have come to know through your careers at the university, sole proprietor, which is a single person business. And what a partnership is it's two or more of these put together for a business. It could be any number of sole proprietors put together, and what they do is they sort of conspire to run a business together for purposes of economic gain, obviously, and the fact that there's two or more together, maybe they get some synergy of better economies of scale, complementary skills, number of reasons why two or more people come together to put together a partnership. They could become a corporation. A corporation will be accounted for in the manner of a corporation because that is a real legal entity. Partnerships are not real legal entities. They are just sole proprietors put together. And the sole proprietorship is not a real legal entity, it's just an individual. So the accounting for sole proprietorships are different than they are for corporations. In today's world, there are LLCs. LLCs are limited liability companies. They are separate legal entities within the 50 states and the District of Columbia, but they are accounted for as a partnership for all intents and purposes. So the partnership accounting, which was dead almost for a number of years because the way of doing business was through corporation for legal liability protection purposes, and often real estate entities would use limited partnerships, but it was a little bit unwieldy. Today there are all kinds of partnership entities out there because LLCs give entities that are partnerships the legal liability protection. Now, just for purposes of describing what I'm talking about, a general partnership that is not an LLC has no legal liability protection. If there's a lawsuit, all the individuals are at risk, and all their individual assets, not just the business assets, but all of them are at risk. So general partnerships were not used by and large for years and years, and so they had limited amounts of entities needing partnership accounting. Now with LLCs, that they have legal liability protection. So now we have a bunch of LLCs that are doing business all over the country, getting that legal liability protection, and it's good for the economy. It's good for people to be able to do business not in a corporation way, which has a little bit more affectations to it, more regulations. LLC is, by and large, not completely, but by and large, easier to operate, legally speaking. All business is tough. It's not easy to make money. Okay, so now that we have it straight as to why there are partnerships and why is there a special accounting? Well, there's a special accounting because the partnership, unlike corporations where in a corporation you have shareholders owning part of the entity, in a partnership you have, and this may seem obvious, you have partners. They own part of the entity based on whatever percentage they have, own part, a percentage. But they also have the ability to be very flexible as to how they share the entity. Here, up in the corporation, it's based on the number of shares of stock. Whatever you hold in number of shares of stocks gives you your share of the company, your share of the dividends, your share of the liquidation of the company. So let's say that again. So it gives you whatever number of shares of stock you have determines what share of the company you have in terms of the amount of dividends you will get. And when dividends are declared by the corporation, it'll determine how much ownership you have when the corporation liquidates and sells out, how much of the liquidating proceeds you would get. And it's fixed by the number of shares of stock you have. You can buy more, you can sell, so you can change the number of shares of stock you have, but whatever number of shares of stock you have fixes your share of profits, which would be dividends. Now, here with partnerships, we have flexibility because the partners every year can change maybe they can change who does the spelling for this slide presentation. They can change profit sharing, I should say. They can change loss sharing if there are losses, and they can share what we call the equity. So in other words, there's three pieces to the ownership of a partnership, unlike corporations, which makes it very flexible. There's the equity ownership, which is the ownership of the assets, or I should say the net assets. There's profits, and those can be changed. That sharing arrangement could be changed every year. And that's just what it means, profits, and then there's losses, how to share losses. So those three pieces are what makes up the partnership with flexibility. Unlike corporations, it's not, you might have an agreement that says, here's how much equity I have. Here's how much profit interest I have. Here's how much loss interest I have. You might have an agreement that starts off day one like that, but you can change that if all the partners agree at any time. Makes it very flexible. So partnership accounting takes this into account and takes into account that it's really sole proprietorships getting together by doing the following. A corporation will have an equity account that you're familiar with. That equity account will be consisting of stock and paid in capital and retained earnings. That's a corporation. For partnership accounting, we're going to change that. We're going to say that partnerships, they have an equity section to their balance sheet, but it's composed of partners' capital accounts. Partners' capital accounts. Imagine each partner capital account being the net value of what someone put into a sole proprietorship from the beginning of the sole proprietorship, and then adding in retained earnings of gains and profits and subtracting out losses. That's what a partner capital account does. It acts as an accounting as if it was the particular partner's sole proprietorship inside the partnership. Let me say that again, or let's illustrate it. If you have a sole proprietorship, he starts out with beginning investment into the business. Over time, he will add retained earnings, and over time he will take out what we call draws or distributions. They mean the same thing. Distributions to himself. Sole proprietorships do not pay salary to the sole proprietor. There is no such thing. They make money. Whatever money they make, they pay taxes on, and they report that income as their income for the year. So they'll have a beginning investment, they'll add in their retained earnings. This is the sole proprietorship equity section that we're talking about. The sole proprietor equity section. A beginning investment, add the retained earnings. That increases the sole proprietorship equity section. And then this is a reduction, so we'll put that in parentheses, is the draws or distributions that they take out. And sole proprietors can take that out at any time. They don't have to declare it like a dividend from a corporation. And since there's no salary, the draws and distributions substitutes for that salary. So this is the sole proprietorship equity. So put two or more of these together in a partnership, and what the partnership accounting says is that the partnership capital accounts will try to mimic this by accounting for beginning investment, even if it's spelled wrong, adding in profits earned and credited to that particular partner, and then subtracting draws. Just like they're called draws for a sole proprietorship or distribution, that's what they're called for partnerships because it's two or more sole proprietorships put together. Each individual partner will have their own capital account following this activity as if it was a sole proprietorship, but it'll be combined into one financial statement, the partnership financial statement. Here, in a sole proprietorship, the accounting is done based on the initial fair market value of the investment. So we actually look at the fair market value of the initial investment in the sole proprietorship for the beginning equity account for that investment we spoke about up here. And so for partnerships, it's also going to be capital accounts at fair market value. And that's a big difference between accounting that you're used to. That's a big difference between accounting that you're used to in corporation entities. Sorry for that. Where there's no fair value analysis or fair value change. In capital accounts, partnerships, there's a fair value recognition. That's why it's included in this course, because we're used to the concept, or we got used to in this course, the concept of when a merger or acquisition occurs, the company purchasing the other company purchases it and books up, as we learned, books up the value of the assets and liabilities to the fair market value at the date of acquisition. So that's cool. That's real cool. Okay, so that means that we're going to do the same thing with partnerships when they start. We're going to record assets and liabilities that are contributed by the partners. We're going to record those on the partnership books at fair market value. Let me say that again. If a partner joins a partnership, or if two or more people get together to form a partnership and they bring assets and liabilities, they'll be counted at the day the partnership begins, like the partner account, like the sole proprietorship accounting, where the beginning investment will be recorded at fair market value. And the same thing in partnership capital accounts. So the entry would look like this, just for illustration purposes. Let's say a partner brings in cash of 100 and an asset worth 200 or 2,000, let's say. So that partnership's capital account And so to balance this entry, this particular partner cap account, capital account, to balance the entry, I think you can figure it out. That would be good. 2,100. So their partnership capital account will be credited with 2,100. Indeed, that's what we're going to be watching in a partnership. Partnership capitals accounts at their credited balances for what they put in. And suppose, just to finish the little bit of the picture, suppose profits are made. So they, at the end of the day, when profits are made, the income is closed to the partner's capital account. This is the closing entry, similar to what we do with business accounts. Corporations' income will be closed. Let's say we made profits of 200. Again, 2,000. There we go. It'll get closed to the partner's capital account at 2,000. And guess what we now have? Let's do a T account. If we did a T account, we would find that at the moment, well, before we do the T account, let's do one more thing. Partner made money in the partnership, and he says, I'd like to have a distribution. I'd like to have the draw. So we'll give him a draw. We'll do it like this. We'll do a draw of 2,000 because he made 2,000. And of course, the balancing entry is to cash. And draws, like income, are also closed to the partner's capital account as a closing entry. So we'll do the debit to the partner's cap account of, that would be a 2,000. And we'll credit the draw. That zeroes out the draw because it's closed out every year. And now let's look at the T account of the partnership in this case. So the T account of the partnership in this case, let's see if we can do it over here. I think so. We can start it. No, it won't work 100%, but it'll give us a better picture. All right, so let's do it over here. Well, it's not going to work as well as I wanted, but it'll get us there. We started off with 2,100. We added in the profits, 2,000, and we subtract out the draws. So our ending partnership capital account will be 2,100, just what we started with in this case. And that's the kind of accounting that goes on inside a partnership. We watch the partner's capital account. The key here, again, one of the main keys, is to know that this goes in at fair market value. And any additions that the partner brings in goes in at fair market value. The cash is at fair market value too. I'll leave that for you to figure out why. Okay. All right, so that's enough for now. We'll take a break and we'll have another session very soon.